Hello, and welcome to the Performance Leadership Learning Lab's virtual roundtable entitled Bridging Cultures, Building Value, the Leadership Imperative in M&A. We're glad you're here and you joined us. A couple housekeeping items before we get started. If you have attended before, you will know that you will receive the recording of the roundtable within the next several days. If you're not able to attend and you registered, you'll still receive the roundtable. And then secondly, if you have any questions for our panelists today, please put those into the chat and we'll cover those questions toward the end of our panel discussion and conversation today. So I would love to begin with some introductions. I'm Will Gladhart, and I'm the Chief Marketing Officer at the Culture Think Tank, and I'll be your moderator today. So we have several different panelists. We're unfortunately missing one, Bob Dunn, due to a conflict, but we'll catch him on the next one. So I'd like to ask each of our panelists to share a brief overview and a little bit about their role and their background. Angela, we'll start with you, and then we'll hop to Lindsay, and then finally Will Lindstrom.
Hi, thanks, Will. Thanks, everyone, for joining us today. Yeah, I'm excited to be here. I've spent over the last 25 years in marketing, business development, and M&A in healthcare. The last 8 years, I was on the buy side in M&A for a few companies doing a national roll-up. Now I'm on the sell side working as a business advisor, working with founder-led businesses to help them maximize enterprise value and create a path to a successful exit.
Excellent. Lindsay, go ahead.
So I'm Lindsay Gazowski. I'm the CEO at The Crucible, which is a leadership assessment built for investor-backed companies and companies that want to be investor-backed. And I'm also a member of the Performance Learning Leadership Lab Alliance. And you can see in Will's background the name SageForge. All of our products combine to make a truly fantastic bit of software that helps companies succeed.
And my name is William Lindstrom, and I am the CEO of the Culture Think Tank and also one of the members of the PL3 Alliance, and have worked, as Lindsay said, worked with Lindsay on developing SageForge, which is all about providing the critical metrics that allow companies to grow quickly and get to exit faster. And so my background has primarily been in turnaround and data analysis and analytics. And so it's been fun to see how we can start to use these technologies to really help accelerate value within organizations.
Excellent. Well, thank you, everyone. I'd like to begin our conversation with a couple thought-provoking questions. Angela, we'll let you kick off. From your experience, what's the first leadership blind spot that typically derails a post-merger integration?
Yeah, that's a great question. There's so much work done on the pre-close side, but really one of the biggest blind spots that I've seen post, integration, post-merger is the underestimating of the impact of culture, right? The real human emotions that come with change. So people are often scared, they're wondering, where do I fit in? Will I still have a job? Will I even matter in this new organization? And those fears can really stall momentum. They can, create resistance. They can actually just completely erode the value that you're hoping to get and unlock in the deal to begin with. So I would say, figuratively, for leadership to kind of put their arm around people and say, you're okay, we've got you, there's a lot happening, but we'll get through it together. I think that, being transparent, as transparent as you can be, at least, and just acknowledging the uncertainty while also building trust with, the new team, it really can help strengthen a culture and kind of get them through those, bumpy times at the beginning.
Great. Other thoughts, Lindsay or Will?
Just to touch on that, I think that's the post-integration. I think that's also where the leadership insights really come into play. So making sure that leaders are aware of of how changes are being reflected in the organization. And I think that's really where I see the work that Lindsay's been doing in helping to identify those critical behaviors and those critical traits within leaders that are going to be successful. So I think knowing that, being aware that that's coming downhill, I think can help better prepare leaders for that difficult transition or that difficult integration. So I think knowing having a sense of where leaders are from a traits perspective and a behavioral perspective to know how well they'll be able to have that empathetic lens, and if they don't, or it's not part of their strength, making sure that they build out the support team that can provide that.
And I think to that end, there's the question of which leaders from which organizations in M&A are going to be the go forward teams. And so if you have leadership teams that are merging, it becomes even more imperative that you understand, what are you all good at? Where are you not going to work well together? How can you leverage your own strengths while also integrating the strengths of the other new members? And if you're taking over an organization where the leadership may now no longer be at the top, understanding what is fundamentally different about how the people that you're acquiring used to be led versus how you have led your organization. There was a group that I worked with where it was two research organizations that on paper looked like they would be a great fit together, not through assessment paper, just on the spreadsheets. And it was a scenario where the one was a highly collaborative, everyone share their ideas, throw them on the whiteboard, let's discuss meritocracy. And the other organization was very structured and regimented and had hierarchies, and people did their jobs. They did them exceptionally well, but they did things in a very specific way. And those two cultures don't mix particularly well unless you're conscious about how you're going to mix them. And so they experienced quite a bit of turmoil in trying to figure out how to fix that until they could align which leadership traits needed to oversee which areas and how to blend those cultures in a way that it kept the best parts of each.
Yeah, great point. So, Lindsay, I think this dovetails really well into our next question. If you could give every CEO one checklist item to ensure cultural alignment post-merger, what would it be?
They need to know who they are before they go into the merger. It's actually not a post-merger checklist item. It's a pre-merger checklist item. And it's figuring out who you are and who the company is you're buying. Do assessments on culture, do assessments on leaders, make sure you understand that point. Everyone does a ton of diligence on contracts and customers and financials and legal. And then they say, yep, and we really had a great dinner with the leadership team. That's not enough when you're trying to figure out, is this a marriage you want to have that's going to help you build value in your company?
Yeah. Mm-hmm. So I saw some other heads nodding. Will and Angela.
Yeah, I'll say I agree with Lindsay. I think she made some really great points. Leadership style is incredibly important, and knowing that ahead of time is really critical. And knowing, even the employees, like you said, their sentiment behind it, how they're feeling about things. And yeah, I think all of that is often the unspoken piece of, mergers and acquisitions and so forth that actually speaks incredibly loudly post-close, right? It's the hardest thing. The post-merger integration is the hardest thing to do and to get it right. And I think, Lindsay's spot on with trying to assess that ahead of time.
Yeah, and I think also just to kind of highlight it, that this problem becomes more of a challenge when you're doing roll-ups and you're bringing one new company in each time, because even though it may, even though you have a new company and you've got 8 and then you bring in a 9th, that new one, every time you bring it in, you're going to have this issue because it's new people, new rules, and they may have different terms. So you may have different leaders hanging around with different roles. So I think it's in the roll-up environment, you really have to be buttoned up in this, because otherwise you're going to be undermining your value, or it's going to slow your ability to scale.
So, good point, Will. So along those lines, how is AI changing the way leadership and culture are measured in M&A and due diligence?
I think in that capacity relating to that, I think what it's doing is it's allowing for a lot of the qualitative discovery that was very time consuming or can only be done one. I think it's going to make that now more efficient and be able to put some more quantitative numbers around it. So I think it's going to help build the awareness of where either leaders are lacking in certain traits, or highlight where you may have pockets of anxiety or pockets of resistance within the workforce. So I think it's just going to create, from a qualitative and a leadership and a culture perspective, better ability to access metrics and better ability to lean on metrics. And from a due diligence process, I think it's just going to speed up the due diligence process when it comes to the financials and some of the critical KPIs. But as we've touched on, and Angela and Lindsay have spoken about, as great as the due diligence is, if the cultural alignment and the leadership alignment isn't there, you're not going to extract the value. So really, I think it just is going to become a game changer in helping leaders better understand how to manage and lead through an integration, because it's not, you have to lead through the acquisition all the way through the integration.
And I think one of the items with the advent of AI and having access to more information is that people need to be clear that they're not confusing operational tools with cultural tools. Because I think AI can do both, but there are a number of HR-related software programs out there, and some of them are truly great, but that are really more about creating operational consistency, identifying opportunities for efficiency gains, or figuring out what processes your best performers are doing differently than others, that may be about culture, but aren't sufficient to determine culture and to determine whether something is progressing in the way you'd like. It might create an efficient culture. It may not necessarily produce a culture that's reinforcing and generating value.
Okay. So I'll throw this out to everyone. So, because I'm sure you all have real world examples, can you share a case where leadership, specific risks directly influence the valuation either before or post close? Anyone?
I mean, I can talk about a few examples where, and I think we all have experience where you get a leader who comes across quirky, is probably the best way to put it, where people get nervous about what that does for an organization, and whether people have managed around that person, or whether that's a culture that is actually generating success. And I think there are businesses that can demonstrate incredible cultures having quirky leaders, and others that don't. But the question underlying all that is, do they still possess the traits that are going to drive success for the future? Are they adaptable? Do they have levels of empathy? Is there a self-awareness? Do they have EQ? Do they have drive, passion, resiliency? Are there components there that are going to help them be great leaders for the future? Or is this a visionary entrepreneur that just got the business to where it is today? And I think that talk to any lawyer out there, and they'll tell you that half their job in M&A is to tell their clients not to talk, because you don't want to create undue leadership risk by revealing that you're too quirky or raising questions where questions otherwise don't need to exist. So, Angela, it looks like you've had similar experiences.
Yeah, I agree with you. I mean, having been in healthcare, so I was often working with, founder-led practices, right, and clinics. And you really have that kind of solopreneur who's the leader, and, their staff are really looking up to them, and they are calling all the shots, right, in the business. And in an acquisition model, that can be very tricky post acquisition, because this type of leader is used to making all the decisions, is used to being very, nimble and making quick decisions. And, it can often be tricky having them now part of a bigger team where they have to collaborate more with other leaders in the team, where they have to get different approvals, where they have to think about brand awareness, right, and brand consistency, and just at a much larger scale. And I think, those are things that are very critical, again, depending upon the acquisition and the size and the market, the industry, all those factors. But I think it can be really important to be aware of that before a deal is done, right? And just understand who that leader is that you're acquiring. And then again, how long are they going to stay? Are they going to stay for a year, 2 years, 3 years, or are they leaving? And all of those details matter in these deals. And so I think they really have to be thought through and questions asked, and just really given some good thought.
Perfect. Well, this is another question for everyone. What data-driven indicators could help investors better account for human capital risk in pre-close? Similar question, but just a little different spin. Any thoughts, Angela? Put you on the spot.
Yeah, I mean, we didn't use any particular data-driven, indicators to assess risk, but I do think that it's important to do, right? I think that, now having been through some, I think it's important to look at things like, employee, employee sentiment, right? And see if you can assess the culture, right? And look at these different things like leadership stability, right? In terms of, is there leadership turnover or even stagnation, right? It could be on both sides of the spectrum. Has there been a lot of churn in leadership, or have they been there 20 years and maybe some of the ideas are a little, stagnant? So I think those are things that you can put in. Even owner dependency, that would be another thing that I would look at too, from a statistical, data-driven perspective, is really assessing how dependent is the business on the founder and the owner. Like, can the leadership team make daily decision making or on their own, or is revenue generation and key relationships, is that tied to the founder? Is that tied to the leader? Right. So I think there's, definitely some things that you can look at to assess what that risk would look like.
I agree. And I think also on the data side, I think that's where, the earlier question about AI coming into play, I think that's where some of these new AI tools, and to Lindsay's point about being more culturally oriented versus operationally oriented, can come to play and start to put quantitative numbers around, to Angela's point, how connected is the leader to the workforce? Is it a meritocracy? Is it, is there an open door policy, or how is it? And then you can actually start to see from a quantitative perspective what the culture looks like. And then that provides the ability to then compare it to the acquiring company, or if you're merging multiple companies together, where is there the overlap? Where is there the disconnect? Because getting in front of that early is going to help. And I think those types of metrics, I think, are going to become more and more prominent as we move forward, simply because the AI can do the qualitative analysis that used to take months or a research team to do. They'll be able to now do in near real time.
And you can also see through a lot of these tools, are there risk factors? Do you have someone on the team has outsized arrogance? A lot of these people have some measure of arrogance. They probably wouldn't have the irrational confidence to do the job if they didn't. But to the point where it's going to be detrimental as you try to grow, or where they may not be able to accept some of the feedback that a new owner may need to provide. Understanding whether the team is well balanced, and understanding whether you have all of the attributes you're looking for there, or if the new owner coming in is going to have to supplement that or grow it pretty quickly. There are components there that are absolutely quantifiable. It's just a question of taking the time and effort to do it.
Yeah, I'll agree absolutely on that. I mean, I think we've all probably seen and understand how AI can just really impact the due diligence piece, right, of M&A and all the numbers and the finances, things that used to just take months and months. They don't have to take that anymore, which is really exciting. And even leaning on understanding how to ask the questions of what are these numbers telling us? What's the story behind it, right? And getting a different perspective from AI on that piece. What's really been exciting to me and a model that I've seen is, I've seen this model where um, the company culture has been put into AI, right? Has been put into, let's say, the bot and saying, here is our current company culture, here's the current metrics, like here's who we are, and then use that to then project and predict some, future, whether that's acquisitions or growth, and really just use that almost incubator to then take a potential deal and plug that in and say, here are the metrics of the new deal, here's the culture of the new company. Does this match where we are now? Does this match where we want to go? And give us even some different projections of, would this work? And if it doesn't, if we don't think it would work, how could it work? Right. So I think that AI can just be an incredible tool for us to give it the data and help us expand our thoughts and really our, ideas around how we can, solve the problems that often come with, bringing different cultures and companies and just people together, right? I mean, at the end of the day, we're humans, and we all, have a lot of different things going on. So I'm excited to see how it really can help us do that part of the thinking. And the numbers is exciting, but really, you're really merging and bringing these companies together on a different level is what I'm excited to see.
Yeah. Yeah, thank you for that. That's great points. So we actually have a handful of questions from the audience. So what three leading indicators tell you culture is compounding value in the first 45 days, and when should each move? Interesting question.
Will, I think you're going to have to take that one.
Yeah, I can take that one.
I know.
So
That's what I was thinking.
so the leading indicator, so there's a couple of in the research, there's a couple of questions that come up that are really good to measure that. And the first question is really around, and it's a very simple question: does my leadership care about me and my professional growth? And if you ask that question kind of on an NPS, that score, if you're in the top quartile, is a strong indicator that you have alignment. If you start to see it drift down and you start to see that question change where they don't feel like they're connected to the organization, you're going to start to have dissonance, you're going to start to have confusion, you're going to start to see the value start to unwind. And what's really interesting about the theory is it takes 90 days to make positive impact on a culture. So as you bring it in, you work your processes by asking that question, checking within your team. That's going to allow you to kind of measure that and see what the impact is going to be. The other thing that's really interesting about measuring it is to provide weekly feedback. This is another thing that's shown to improve task performance by 6% and profit by about 8% over a 9-month period, which is if you provide weekly feedback, every company's doing it on a Friday. Here's what we heard. Here's what we learned. What else can we do to help you? And you get that feedback back in and you respond to it every week. That's going to build up resilience within the organization and alignment within the organization. People feel connected. And that again is something that you can measure because you can put it on an NPS score, a net promoter score on a 1 to 0 to 10 basis and say, how well are we listening? How well are we promoting, recognizing and helping you achieve your goals? You can ask those very simple questions. So that takes, you'll be able to see the improvement over a 90-day. The last element that we've been working on is measuring anxiety, which is actually, we use Csikszentmihalyi's model of flow, if you're familiar with it. Basically, it correlates how people are feeling to a degree of anxiety within the organization. And so that's one of the key metrics. When you see that anxiety start to rise quickly, you almost always, it's correlated to some type of negative outcome. In healthcare and critical access hospitals, for example, it is directly correlated to absenteeism or call out the next month. So if the anxiety rises, you can anticipate people are going to start calling out if you don't address it. So those are some of the key metrics. So by monitoring kind of where the anxiety level is, by providing feedback of where the company's going, particularly during the integration period, and then asking for feedback, like what else can we do, you're going to help address that, and then you can monitor those metrics over time.
Perfect. So I have another question. If you quantify leadership readiness and diligence, what pricing delta or term shift have you actually seen versus deals without it?
So this is where Bob would be helpful on this. So we
Yeah.
tie in SageForge the leadership and cultural elements into GF data and can show a delta on basically certain levels indicate certain potential advances and declines. Of course, that's all ongoing stuff. And as people fix things, it shows where they would then fall against it. So it's not, I don't have the data in front of me to say, here's what someone did X and it translated to Y, cultural alpha basically in their new price. What I can say on some of these fronts, and then Angela probably has some direct examples as well, that there are investors out there who actually will pay a premium when they know that they can remove the leadership completely, because it's such a high risk to not know what that is. And if they can just replace it with a group that they know, they'll pay a little bit more to get those people out. There's also frequently people trying to solve for that problem by doing a number of things like earnouts or creating cultural elements that are tied to portions of the eventual payments because they're trying to mitigate those risks. And so, while I think it's in some ways outside of looking at that GF data tie within SageForge, a little difficult sometimes to figure out what that quantification is of doing certain activities upfront and the ROI that that's going to generate directly. The flip side of it is that you do get significantly increased when you have higher rates of employee engagement and cultural cohesiveness. It's roughly a quarter more in productivity than you would see otherwise. If you can get 25% more productivity, that's going to increase valuation fairly substantially anyway.
And the one case study we have that kind of ties to what Lindsay was saying is when we measured, there was a concern about skilled engineers leaving. But when we were able to demonstrate the strong connection between the workforce and the retained leadership, so the founder was stepping away, with the retained leadership, that there was a strong connection consistently over time that was done pre-sale and was that actually translated into an 18% increase in the exit premium. And what's interesting about that is it wasn't really an on top. It's this, if there is leadership risk inside, the valuation, there's usually some type of company specific risk premium that can be anywhere from 10 to 20%, but the acquiring company felt strongly and the selling company was able to demonstrate the strong connectivity. So they just basically took that specific risk down to zero within the valuation, which added back 18% premium. So when you can demonstrate that there's strong connectivity with the workforce and the retained leadership, you're basically just reducing that risk premium and are able to extract greater value. So that is just one case study that we monitored during a field test, but that's what it translated into.
Excellent.
Yeah,
Oh,
just
go
to
ahead,
add
Angela.
to that,
Sorry.
I mean, you know, what you're saying, and I would say what I've experienced having, you know, with being on that buy side is just communication is so important, right? I mean, just ongoing communication post merger, post acquisition, between leadership, between the employees, about what's working, what's not working, what's being fixed, all those things I just think are so critical. When that communication isn't there, it just creates this void, and then people get scared, right? And they start to come up with their own ideas and try to solve their own problems. And I think just the more you can communicate, the better. And you know, even with leadership, like it's just unfortunately, I've seen the reverse, right? Where some of these clinics we acquired, and they did have earnouts. You know, the leadership, um, you know, still wasn't as consistent with the culture. They didn't want to kind of conform to the new right? The new company. And it really impacted not only the revenue, but just the overall company in general, right? So I think that those are things that really have to be looked at and addressed early on before, and then, you know, for the first 90 days specifically post close. I think it's just really important.
I think this dovetails really well within our next question. Um, One of our guests commented that I joined a shop post M&A several years after, and it was obviously the acquired companies were never merged. Is there a point at which you need to pivot to the creation of a new culture versus attempt to get them to?
Did we lose him?
We might have. I think we can see what the chat says. So
Yeah, so I can, so yeah.
Hold on.
And so the question is there a point at which you need to pivot to the creation of a new culture versus attempting to continue to adapt the parent's culture?
Correct.
I mean, I will say, you know, from my experience, I've been part of two companies that were acquired, and then one of those companies we were acquiring, right? So I've been on both sides of it. I would say culture's fluid, right? I think that there isn't a set culture. I don't think you're ever done. I think it's one of those things that just constantly evolves as the leaders evolve, the leadership, the employees, the market, the world, right? I think it's just not something you can, you know, carve up and put on the wall and just, you know, kind of wash your hands with it and say, we're good. I think that it has to evolve. It is a living thing. Culture is a living thing, and it evolves. And as you bring in new companies, new people, new leadership, I think that it just has to evolve. Otherwise, then it becomes this huge problem, which is kind of what you're alluding to here. It's like the elephant in the room. Everyone knows it's there and they can feel it, but no one wants to actually talk about it. So um, that's my perspective on it.
and
No,
I think,
go ahead, Lindsay.
oh, please. Well,
Oh, I was going to say, I agree with that. I think it's when that culture is always evolving, you have to be on top of it. But I think it's when you know, as leaders, if you just assume that the culture that you had is going to be there, or you're not being open and aware of it, or being flexible enough to allow it to change and kind of adapt and mold. Because when you bring, like anything, when you bring different groups of people together, there's going to be certain rhythms that are going to form, and you have to be accepting of those rhythms and figure out how to integrate it. I think it's when there's a resistance to anything that, because I've been on the other side of being acquired, there's sometimes of the acquiring company, there's sometimes resistance to accept anything new from the acquired company versus just recognizing there's going to be fluidity to it, and recognizing that there's certain things that are good, and take what's good, but and take what's bad. I think it's when you have the rigidity of this is how it has to be, that's where things start to unwind, or the value is being destroyed or not extracted.
and it sounds like the case that the person asking the question is describing is where there was not a conscious effort to establish, develop, or create any form of culture. And any group has its own culture. And if you don't consciously create it, it creates its own. So if you have two companies that you're putting together and there's no effort to create a consistent culture, whether that's the parent culture, whether that's a merged culture, whether that's a brand new culture, if you're not being conscious about it, each group independently and in their own ways is going to create a culture, and those could merge together or they could very much fracture further. And so I think it's just important to be conscious and continuously conscious about creating culture. It's not an exercise you do once in a conference room, put it on the wall, and be done with it. It's something that has to be actively engaged on a regular basis.
Lindsay, I completely agree with you. I think if you're not consciously creating it, then you might end up with a culture that you don't want, right? I mean, that's
Right.
the other piece to it is you can't be open to everything, right? I mean, it's great to be open to ideas, but at some point you have to say, like, this is who we are, this is what we stand for, these are our values. And if you're not aware of it and on it and creating it, you might end up with something you actually don't want or pieces that you
Right.
don't want. So yeah, it's a really great point.
Yeah. So thank you for that. Will Lindstrom, this question probably will speak directly to you. Are there data-driven metrics that can assess aspects of culture that can be used in pricing the deal and then retained to track changes, progress through integration and beyond? Comment is that culture remains a soft, subjective deal component. Otherwise, it's hard to credibly assess that risk.
So the answer to that is yes. So that's part of what we worked with on Sageforge. So we created something called a culture performance score, which is based on performance management theory, and it converts qualitative metrics into quantitative. And what it really does is it looks at four key questions. How is the workforce feeling in one word? Are you feeling in one word, which gives you the degree of anxiety? What do you need your leader to start doing, continue doing, and stop doing? So those are those leadership behaviors and actions. And by putting a number to it, where it really provides strength, is it allows you, especially in multi-unit facilities or multi-divisional facilities, like for example, Toyo Tires, will use it to understand what is the leadership performance between shift one, shift two, shift three. And then by looking at the needs, what is the needs that are being unfulfilled within the workforce, and then how do you address it? Now, it's not going to perpetually keep going up, but what it does do is it allows you to see how different leaders are working, which leaders are performing better. And in multi-unit locations or multi-shift locations, it allows you to start to really compare which leaders are doing well, and then know how to develop which leaders. And that's where the traits come into play, by understanding which traits are most needed and which traits need to lean into, which gets back to, I think, Angela's point about having those cultural values. So you're aligning to those values. So it can be done, and it works that way. As far as priced into the organization pre and post, what it really does allow is, when you're starting, especially in a roll-up environment where you have multi-locations, when you're bringing in those multi-locations, it allows you to proactively understand which areas have strong leaders, where you need to develop those leaders. And in one large franchise client that we've worked with, they used it to monitor store-on-store sales. And so by focusing on those areas that were lower, and by focusing on those traits, they were able to improve store-on-store sales by 4% in the underperforming areas. So they were able to bring them back up, level them back up to where they're performing, just by having the metric and understanding where and how to develop. Because oftentimes the leaders know how to do things, they just don't necessarily know what they need to do right now to make the biggest impact. So that's where the scores come into play, and how they can be used to drive and continue and to extract value.
All right. So I was just asking if the audience had any other final questions for us today. We'll just give it 1 sec, and then we will wrap our session. So thank you so much for joining us today. We hope you enjoyed this conversation on bridging culture and building value, the leadership imperative in M&A, in order to create stronger outcomes. This roundtable is part of a monthly series from the Performance Leadership Learning Lab, where we explore topics like leadership, organizational performance, AI, cultural alignment, and investor decision-making in greater depth. Next month's topic will be titled The Syndicate Advantage, Redefining Value Creation for Small Business Exits. We hope you will join us. To learn more about us, visit www.pllab.com. We'll see you next time.